Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments.
Good morning. You're watching the market right here on ET Now, and this indeed is the top story right now. The Fed, while they have paused this time around, but they are signaling more rate hikes and a target range of 5.25% to 5.5%. And you have seen already the US 10-year yield spike. It's now near a 16-year high. So yes, you know what exactly we were talking about, that the global macro setup, that's looking a little bit wobbly right now.
Okay, so let's understand what Fed has done. Now, they've not increased rates, but they've given a very rosy outlook for the economy. And the choice of words, I think, is very important here. I was scanning things in the morning. The US economic growth from moderate has become solid. Now, this is US Fed talking about their US economic growth rate. The inflation remains elevated, and US job data has slowed down but remains solid. What Fed has done, I guess they really in a sense have given a very bright and a very chirpy outlook for the US economy. Now that is something which markets are happy and perhaps unhappy about. Happy because that clearly means that the US economy ain't going to slip into any kind of an recession or soft landing or hard landing. That entire fear is now on the back burner. But that also means that the market, the credit market, has already started pricing in a very different kind of a scenario, and the real rates in the system have moved higher. That explains that why, despite a no rate hike, the US 10-year, 30-year and 2-year papers on your screen. That's Fed inflation outlook. But let's look at the 10-year. It is at 4.4. It is at a 16-year high. You can throw in the 30-year paper as well, indication of the long-term structural rate, and then the near-term paper, which is the 2-year and the 1-year bond yields. They all have shot up. Net impact, well, sometimes good news is bad news, and that is what is happening in Asia, and that is what SGX is indicating. 20,000 today will be broken.
And I think what the markets are also reading into is the fact that while the Fed may have paused this time around, they have signaled higher rates for longer. And I think that is what the market is also not liking. But anyway, let's just tell you what exactly transpired with the global markets overnight while we were away. And you have seen a bit of a step back for at least the US equity markets, about a 1% slip coming in for the S&P 500 index, a good 1.5% fall coming in for the NASDAQ as well. And Asia too is a sea of red all across. In fact, you're seeing cuts of anywhere between about 1% on Japan, on Australia. Kospi is down over 1% right now, and Hong Kong as well has fallen by over 200 points. That's pretty much in continuation with our market trend from yesterday as well, when we did breach those critical levels and did fall sub that 19,900 mark as well. And this morning too, it's no different. We're down 123 points on the Nifty implied adjusted rate.
Yep, and just to sum up, Nikunj, how we wrapped up yesterday's trading session, as you said, it was around the 19,900 mark, and it was a lot of the heavyweights that put pressure on the frontline index. In particular, if you take a look like a constituent like HDFC Bank, that alone cracked about 4% in yesterday's trading day. So yes, indeed, that was a sector. Reliance Industries and HDFC Bank, both of those stocks led to the mammoth fall in the index, half of the Nifty fall. PSU banks as well saw a bit of profit booking, and banks, metals, realty, all of those indices, Nikunj, yesterday in trade did come under acute pressure.
See, Reliance and HDFC Bank are not moving on the right side. And when I say right side, all of us thought that, okay, it was like a passing the parcel, small cap, mid cap, and then large cap, and the breakout in Nifty, 20,000 plus. Everybody preempted in a sense that the bank Nifty was coming back in vogue. But yesterday's brokering, the downgrades which have come out for HDFC Bank, the fact that GRMs have collapsed globally, Reliance ain't going anywhere. FI selling at best you would say is patchy. And that combining with this risk-off moment in the world, I think markets may just get jammed. So you cannot make a call that markets are going to reverse sharply because there is enough and more liquidity, there is enough and more money coming from DIs, HNIs, family offices, all those factors would be at play. But in the near term, to assume that this narrative of the market, which looked like it would have shifted from small cap back to large cap, that narrative needs to be revisited. It would be a weak Thursday morning for the market, then you got to take it from there. But the global mood point clearly is good and bad both. Good because Fed has given a very rosy outlook for US economy. Bad because if US is coming back, that means rates will remain strong. And if we are in for higher for longer kind of a template, what does that mean for emerging markets? Let's understand that and let's discuss that, and to understand that, let me now bring on board Adrian Mowat. Adrian, good morning. Thank you for joining us. Would you agree with our assessment that Thursday morning there is good and bad both, depending on whom you are asking?
Yeah, so the good is that the US economy continues to have strong momentum. The household sector is benefiting from a strong labor market. And obviously the bad news, as you allude to, is this means that US rates remain higher for longer, means the dollar tends to be a firm situation, particularly in contrast to some of the Asian currencies like the yen, where the Bank of Japan is going to continue to run a very accommodative monetary policy. So it's a sort of classic sort of tough environment for emerging markets, this strong dollar environment, this high interest rate environment.
So do you think this entire risk-on rally in emerging markets now naturally because of global macros could come to a pause, because it's been a good year in general for emerging markets?
Well, it hasn't really, because the largest emerging market, which is China, is having a very poor year. And so, out with China, we've seen a little bit of strength in some of the large cap tech stocks in Taiwan and Korea. India's proved to be a bit more resilient. But it's not a strong environment for emerging markets. And because China is doing poorly, then when I speak to emerging market fund managers, they're trying hard not to have redemptions, and in many cases they are having redemptions. And I think to some extent, India is suffering from the problems in China, because that's leading to people being very circumspect about investing in emerging markets.
Okay. Adrian, if the template for US will be strong, indirectly, what do you think that means for the world? Because if the biggest economy in the world is growing, that's actually not bad news if you just think about it.
No, I agree. It's good. It's, that to have an economy, a global economy that continues to expand maybe at a more modest pace next year in itself is not a bad thing. And, growth within your economy in India remains quite robust. We're seeing okay activity in Southeast Asia and the big economies like Vietnam, Indonesia, etc. In Central America, there's a little bit of easing going on. So there is some good news out there. But I do think there's a very important market that we need to talk much more about, which is the long end of the bond market in the United States. So bond yields have now moved up to around the 4.4% level. Now, the yield curve in the US remains the most inverted that we've ever seen since Volcker was in power as the central bank governor, or the Powell equivalent. And when Volcker was in power, short-term interest rates went as high as 20%, and you had an inversion that arithmetically was a bit bigger than the current one. So we've got a US economy that looks as if it's more resilient and an inverted yield curve. And people put a great deal of store behind the yield curve as if it's this, a divine indicator that can't be argued with. I would suggest that the yield curve is wrong and that US bond yields need to move higher. And to some extent, we're seeing that going on as people say, look, if I can get 5.25% in a money market fund, why am I getting a lower yield taking on duration risk when the economic data looks good? And so I think for this year, it's going to be the sort of pain trade is bond markets being weak, bond yields moving higher. And as bond yields move higher, then your discount rate, your key discount rate is moving higher. And so that puts a little bit more pressure, particularly on asset markets like infrastructure, property, which are very sensitive to cap rates, to discount rates.
But Adrian, does that at large also spell bad news for equity markets as an asset class?
Well, I think it impacts equities where the discount rate is important. But I would suggest that, where I'm much less worried about the equity market than I would be worried, the listed equity market, than I would be worried about private equity, than I'd be worried about property markets. Because at the end of the day, the move that we've seen in the US equity market, I know a lot of people want to just put it down to AI, but if you look at what's happened with the very large cap stocks, their free cash flow generation has accelerated meaningfully. And so there's been a good fundamental driver. If global economy continues to expand, then the earnings outlook is probably more resilient than people expect. So equities, I think, would rank much higher than bonds. But yes, be sensitive that you've got the right conservative discount rates when you're looking at valuations.
All right. Thanks very much, Adrian. Good to have you on board as always and give us a better insight as to how things are trending across the globe and what you made of the Fed rate decision. Let's focus back home then, and it's interesting data that we've compiled, in particular talking a little bit about the power sector. Now let's pick up some names: Reliance Power, Ratan India, Inox Wind Energy. And if you take a look at the kind of financials that they have delivered for FY23, mammoth losses. 1,800, for instance, for Ratan India, 600 crore rupee loss. And Nikunj, yet on a year-to-date basis, the returns are quite staggering. That was an interesting point that you brought up. What exactly is it indicative of?
No, see, okay, now let's understand the dynamics which are at play. Not every power company is bad and not every power company is great. Power is not like, banks where you can look at NPA cycles and the credit cycle and then you would say, okay, one will grow, other will grow. It's about the difference between the growth, who gets more. In power, it's a very complex sector. There is merchant power, there is, there are PPAs, there is installed capacity, there is fluctuation which happens, there are overdues. So all I'm saying is that in power, just don't buy because there is a prefix power or there is a suffix power. You have to do your homework when you're buying into power stocks. And all the companies which are there on your screen, they have different business models, very different setups and very different, very different template in terms of how the business would be done. Now, why am I bringing this part up is all I'm trying to bring out here is that look at some of these companies, and I don't think some of the names on your screen have anything very, very strong in terms of the operating, template they have. So FY24 is not going to be dramatically different and nothing meaningful will change in FY25 for some of the power companies. And these stocks are moving up like a rising tide. So it's a rising tide phenomenon, which I think is at play, at least in the mid-tier and the tiny toons of the power sector. And when that starts happening, you could ask yourself, why? Is it worth it? Where is margin of risk? Just don't get drawn because there's a rally in some of the big power companies and you are reading a headline about power shortage. Yes, there are few power companies, we've discussed them. They are in a sweet spot given where the power demand and the dynamics are moving. But that rub-off effect, I think, is now visible in equity prices in some of these power stocks, and which is why you need to be careful of. That's my limited point. I'm not judging. I'm putting facts out on the table.
Yeah. The other thing, of course, is the fact that government is looking at that near 5% stake in SJVN, and the series of OFS stake sales that have happened. Be it SJVN, HAL, Coal India, RVNL.
See, actually, think about the government of India being a promoter, and the promoter needs capital to grow, and if they're getting a price at which they are able to perhaps monetize some of the investment, why not? So I think really from a government standpoint, if you're going ahead with the OFS in order to meet your disinvestment target at these levels, I think it is in favor of the government. But from a market standpoint, I think this is a supply risk which emerges. See, for some of the government stocks, the government ownership is very high and it's very tightly held. So the free float is low, and because the free float is low, the price action in a sense tends to be very concentrated. But the risk with some of these companies now is that at the current level, given that the disinvestment targets we are nowhere close to the disinvestment targets, nothing's happened on Concur, nothing has happened in IDBI Bank so far, and there is a massive rally in some of these power stocks or government or railway stocks, the temptation to do OFS, I think, would be logical. So I will not be surprised that while government has maintained a very strong discipline, they've kept up to their commitment in terms of not diluting stake via the ETF route. But at these levels, where government concentration is high, I will not be surprised that in the near term, the supply from the government stable in some of the key outperforming names, where the government holding is very high, could be real.
Okay, let's find out what our chartists make of the lay of the land and how the markets trended yesterday. We've got Nooresh and Kunal, as always, joining in. Kunal, let me begin with you then. Large caps really taking a pounding in trade today. For instance, RIL, HDFC Bank, they were the critical losers in trade, weighing down heavy on the frontline index. What do you make of that?
Good morning, Gavan. So yes, there was a sudden weakness which had actually come back into a few large cap stocks. But the data on the index front itself is very stunning because in the last 10-12 days on the September futures, we've seen a 50% drop, almost a 45-48% drop in the open interest for Bank Nifty futures. And I think if I'm not wrong, we are almost at one of the lowest open interest on the Bank Nifty futures over the last many series. So that generally indicates that there's been a major unwinding of positions on the banking index. And on the other hand, we saw a 12% drop on the Nifty futures. So, in terms of the open interest, we are back at, 5th of September, 4th of September, when the index was at 19,600 levels, which means that yesterday's day was not just an exceptional day in terms of the large cap stocks being under news, under some sort of a selling pressure, but there was a major unwinding which had happened for both the index Nifty as well as the Bank Nifty. And I think that should probably indicate that there could be near-term concerns for the indices, and I think one should start getting a bit of risk off from their individual portfolios as well.
Right. Nooresh, hi, morning. It was all about HDFC Bank and RIL yesterday, wasn't it? Do you sense more pressure on these two names?
So, yesterday was a lot of volumes also on Reliance Industries. So we need to see whether it can sustain below 2350, 2340 levels. Then there is a lot of pain on the downside. Otherwise, Reliance could pause. HDFC Bank still has some more room till 1500, 1530, which was the recent low. So the heavyweight problem continues, and that's the reason we expect indices to have a slow trend. Closer to 19,800 is where I expect a recovery from, as closer to that. Similarly, 45,000 on the Bank Nifty. So it's a buy on dips if we get closer to that today.
All right, that's a buy on dip strategy. Let's find out some individual stock calls as well from our chartists. And Kunal, what are you flagging off this Thursday morning?
So I'll go with a mixed bag in terms of trades. First one is a buy on Concor. The stock looking relatively stable. Yesterday also the stock made a fresh multi-day, multi-week swing high at 740 plus levels. So would suggest a buy with 765 as a target and stop loss at 732. And second would be a sell on PI Industries. The stock showing signs of an early chart breakdown, breaking below the level of 3,500. So would suggest a sell with a target of 3,400, stop us at 35.55.
Right. Nooresh, what stocks would you recommend?
So first is again a buy on Container Corp. We are seeing good momentum across the PSU pack. And that is where Container Corp also has given a short-term breakout yesterday. Expecting this to may even stretch up to 800, stop loss at 720. Second is a buy on Federal Bank, one of the few small cap, mid cap banking names which continues to be closer to an all-time high. Making that breakout about 135, 140 levels, the stock has been consolidating at a band of 140 to 149. Above 149, 150 could see a quick 10% move. Stop loss at 140, target price of 165.
All right, there you have it. Top trading calls to go with this morning from our chartists. Let's shift gears then and let's put the spotlight on individual stocks on the radar today, or stocks in news. And Anisha is joining in our studios. Two Morgan Stanley calls. You've got Indigo and Nykaa. Let's start off with Interglobe Aviation, or Indigo, and it's an overweight rating. We've seen a lot of issues as well emerging with Akasa. What exactly does Morgan Stanley have to say?
Well, the Morgan Stanley note is talking about how we have seen a bit of recent underperformance in the stock price, and there are a lot of negatives that we are talking about in the industry. But nonetheless, Indigo is well placed. They're maintaining the overweight stance. They have a target price of around 3,217 rupees. Yes, they're talking about how the rising ATF prices and the weak INR poses a downside risk of almost 10 to 13% when it comes to the FY24 EPS. But if you look at their FY25 estimates, they were already penciling in a higher crude price, so it hasn't materially changed their FY25 estimates. Even for FY24, they say that recently we have seen the crude headwind, the engine concerns and promoter stake sale that have led to the underperformance in the stock. But it's a favorable seasonality as well as high leverage among Indigo's peers that should enable the industry actually to pass on some of the cost pressures, and it will be a good news for the likes of Indigo, which will be able to pass on the cost pressures given the reliability and the brand recall it has in terms of the customer as well. In fact, they say that they would look at building position into bad news flow, as Indigo is a strong franchise and industry consolidation is underway. And we know and we have seen, Nikunj, what happens when industry consolidation happens and the leader just becomes stronger.
See, I think FY24 will be tougher for them, whether it is engine issue or what's happening in crude. But what is important here is that 6 months out, 12 months out, will the scenario change? If you work with an assumption that crude prices will not remain high for long, then things could be dramatically different. B, there's a massive fleet expansion which Indigo has embarked on, and I don't think the engine issues are going to be something which are going to be permanent in nature. But the fact that Indians are flying more, the fact that yields are going to be increasing more, the fact that industry is consolidated, those are multi-year trends. And those are trends which in a sense will benefit a company like Indigo because they are efficient and they have a sizable advantage in terms of market share and they are going global. So what could be called as a near-term 2-quarter challenge, I think, which has compressed the stock. It may decline further because in the short term it's about the map with Indigo and crude prices you can map in the short term. So if the stock declines, I will not be surprised that big smart institutional buyers really would be there. We've always said that Indigo airline is a tough industry, but that was a different time period when airline was a tough industry. Right now the Indian airline industry, at least in my book, is a sunrise industry with a huge advantage in terms of per capita desire to travel, more connectivity, fleet expansion, no disruptive action. All those factors put together next 2, 3, 4 years, I think look very good for the airline sector in India.
Okay, and the other interesting note is on Nykaa by Morgan Stanley. While they're saying that there is a structural increase in beauty spends, which is visible in India, what do they have to say about the fashion business? Because that was the niggling worry for Nykaa, right?
Yes, and that continues to be the niggling worry for them as well. They're talking about the fashion business kind of pulling down and dragging the business. And it's very interesting because on one end, Morgan Stanley has actually increased the target price on Zomato today. They've pulled forward the profitability assumptions when it comes to Zomato. The target price is 125 there. But for Nykaa, as you pointed out, they've cut the target price very marginally. And they're talking about how survey is indicating that there's a structural increase in the beauty spending. And the medium-term thesis on the beauty business continues to be quite strong, but it's the sluggishness in the fashion business which is triggering of a earnings cut. And in fact, they have lowered the GMV estimates or the gross merchandise value estimates for FY25 to 27 by 6 to 11%, and going forward, they're expecting that the growth for the BPC segment is going to be around 30%. For fashion, it is going to be a bit lower than that. But overall, if you talk about their takeaways with respect to the brand value and the utility that Nykaa is serving in a lot of regions of India as per their survey is quite strong. That is why they're maintaining the overweight stance, but a small tweak when it comes to the target price.
It may be a small tweak, but it's a call which you need to take on where Nykaa in a sense will come back, given that the competition in the space will only intensify and fashion unfortunately is getting highly competitive and their own brand launches have not done exceedingly well for them. Look, there was a time when Nykaa was enjoying a pedestal positioning. Now it's gone on the back burner. Variety of factors, perception, business, competition, the way how that entire bonus issue was handled. I think Nykaa in a sense has been really on the receiving end. And typically when the positioning changes, Nisha, there are two factors to any stock price. Market price is a function of EPS into P. P is something which can change dramatically. It can change within a quarter, it can change within a year. We've seen that, P expansion, P compression, and that's sentiment and that's the way you view the stock. So I think more than the earnings upgrade or downgrade for Nykaa, I think it's going to be this entire perception which has changed. If they're able to fix their fashion business, if they're able to convince the market, look, we will continue to do very smart capital allocation, nothing disruptive, and the fashion business stabilizes, the stock may come back. It may be the comeback story of second half of this year or the first half of next year, like Zomato and, Paytm. But as of now, I don't think there is a compulsion for anyone to buy because the other fintech stocks, I think, are in a much better spot. Nykaa was in a better spot when others were in a bad spot. I think the reverse is there right now.
And Anchit Nair just spoke with us about a week ago and he said that Nykaa fashion stores is a pilot that's underway. Expansion of stores is also a possibility. So we'll really have to see how they take forward that business or deal with that stumbling block. Thanks very much, Anisha, for joining in. All right, let's hear it out from other top market experts. The defense sector has witnessed a rally in the recent past. Nilkant Mishra believes that the sector has good medium-term opportunity, while Sanjeev Prasad says that the sector is promising in the long haul, but valuations are not comfortable in the short term. Listen in.
On defense, I think it's a medium-term opportunity, meaning that we know that there is going to be more focus on Atmanirbharta, that is more self-dependence. Globally, spending on defense is starting to go up. And when we think about defense, we have to think beyond just, the final assembly of submarines or the final assembly of planes. It has to be the whole ecosystem. As a theme, I'm observing that because everyone wants to invest in defense, everyone wants to invest in railways, there is a very steady rise in price to earnings multiples without an appropriate visibility on what's happening to their own order books.
Even though we are quite positive on the longer term story of more spending by the government on defense capex, more international taking place, we should all be positive for defense stock, but a lot of good news and more is actually getting priced in. So that's a limited point we're making out in many of these reports that we have been putting out, that we are not comfortable with the valuations.
Welcome back. Now, in other news and updates that we're tracking, India has taken one more step towards creating history. The dream of women reservation in the Lok Sabha and state assemblies is in sights as the Lok Sabha passed the Women's Reservation Bill just yesterday. This named Nari Shakti Vandana Adhyam during the special parliament session, where 454 MPs voted in favour of the bill, while 2 MPs voted against it. The voting proceeded by nearly 8 hours of discussions, which saw leaders from both the opposition and the government expressing their views on the bill. Let's listen in to the Lok Sabha Speaker Om Birla talking about this historic bill.
शुद्धि के अध्ययन मत विभाजन का परिणाम इस प्रकार है. हाँ 454, 454, 454, ना 2. प्रस्ताव सभा की कुल सदस्य संख्या के बहुमत द्वारा तथा सभा में उपस्थित और मत देने वाले सदस्यों के कम से कम 2/3 बहुमत द्वारा पारित हुआ. अब खंड 2 विधेयक का अंग बना.
All right, get a move on then. And according to sources, the leaders of the crisis-hit Go First airline have extended the deadline for the submission of expressions of interest to the 28th of September. My colleague Ankur Mishra has more details. Ankur?
Yes, sources say that Go Air lenders have extended the deadline for EOIs because there has been limited interest which was shown by the potential bidders so far. In fact, if sources are to be believed, some of the bidders had expressed reservation for submitting the EOIs within the earlier deadline, and hence a request was made for extending EOIs once again, and this is the second time that expression of interest deadline has been extended by the lenders. Now, as far as the current process is concerned, we understand that the latest deadline is September 28, by which the potential bidder needs to express the interest for buying the company, and after that the prospective resolution applicants will be finalized by the lenders by October 8th, and later in the month we understand that final bids may be invited for Go First Airline. Now the airline has been trying to revive itself to fly in sky once again, but due to operational issues as well as the pending litigations which are there in various courts, the operational issue has not been sorted, and it is yet to revive itself in form of operational ability as well as the resolving the debt. Lenders are seeing to resolve a debt of over 11,600 crore. In fact, if sources are to be believed, the overall debt could be more than rupees 20,000 crore due to claims which have come so far from operational creditors. But as far as the financial creditors are concerned, the total debt is more than around 6,500 crore, which includes lead credit Bank of Baroda as well as Central Bank of India.
Right, Ankur, we'll leave it at that. Another ETNA exclusive, and seems like there is a new twist in the Cipla promoter stake pot boiler. We learned from reliable sources that Blackstone is actually pulled out of the race. My colleague Anurag Joshi joins in with more details on the same.
Yeah, that's correct. So Blackstone has pulled plans to acquire a 33.5% equity holding in Cipla, which is held by the promoters of the company. That's the Hamid family. The key reason why Blackstone has pulled out from the race is because it perceived the purchase cost for Cipla, which is said to be around $7.3 billion, to be too high. Blackstone had put a non-binding bid for the stake in Cipla. So that now leaves a key contender, which is Torrent Pharma, as a contender for the promoter stake in Cipla. And Torrent Pharma is scurrying to put together a private equity consortium. They're trying to bring in additional investors into the deal because the deal size, the sheer size of the deal, which is over $7 billion. They've tied up $4.2 billion of financing. This is what our sources are telling us. That includes a $3 billion syndicated loan, and $1.2 billion will be a promoter financing, which will be loans against the pledges of shares in the Torrent Group companies. The third contender, which is also looking at the deal, is Dr. Reddy's Labs.
Thanks very much. That's the latest that we're picking up on Cipla. Moving right on then, FMCG giant Tata Consumer is reportedly leading the race to slurp up Capital Foods-owned Ching's Secret. Let's get in Vinny, who joins us with all those saucy details. Vinny.
Absolutely, and we had heard this before also in the month of May, somewhere around, that, Ching's was on the block and there were a lot of FMCG players that were actually looking to buy. Now, what ET report is suggesting that Tata Consumers is leading this race to buy Ching's Secret. That's the Capital Foods Limited company. Now, obviously, they're valuing the company at around 5,500 crores. Furthermore, ET report is suggesting that Tata Consumers will first buy 65 to 70% of the company from three investors and then acquire the remaining stake over a period of time as well. Now, Capital Foods, three main investors, when you talk about it, who are looking to sell this their stake, is one of them is Invest Group, which has 40% stake in the company. The other one is the PE firm, that is Group P Group, that is General Atlantic, that has 35% stake, and the other one is Ajay Gupta, who's 25% stake he has, and he's the founder and as well as the chairman of Capital Food and a former advertising boss as well, and advertising worker as well. So let's keep an eye out on Tata Consumers. Obviously, this potential buyout will put Tata Consumers and give them the uphand and increase their expansion in terms of the food portfolio as well, in the noodles portfolio, and put them against Nestle as well, which obviously has Maggi. So let's keep an eye out on that one, because Maggi has 60% share, and obviously with this portfolio coming into them and increasing their brand over there with Ching's, if they actually manage to acquire that, that's going to be an interesting buyout coming in for Tata Consumers.
Okay, Vinny, thanks as always for those details. Let me take it across to Anisha as well. And remember, Morgan Stanley has maintained its outperform on on a couple of electric manufacturers. So what's the rationale behind this upgrade? Let me go across to Anisha and find out exactly that. Anisha?
Oh, well, yes, it's an initiation happening from Morgan Stanley, and this is coming in on a couple of electronic manufacturing company. Keynes with an outperform rating, the target price around 2,440, and Sirma SGS as well. They are maintaining the target price there at 671. Now they are talking about how India is all set to become a manufacturing hub going forward, and that's because we are seeing a lot of polarization in the world, and one of the big transformation and key pillars for India to reach its vision of $5 trillion economy is going to be offshoring. Of course, India on the supply side is well placed because it has a large and growing working age population as per them, and the surplus low cost labor as well. So they are saying in terms of offshoring, India is best placed, and even if you look at the electronic manufacturing, that's expected to achieve a CAGR revenue growth of almost 21% and reach $604 billion mark by FY32 itself. They are more favorable towards the B2B company versus B2C company, hence they have an underweight stance on Dixon but an overweight stance coming in on Sirma SGS as well as Keynes. That's because they believe these companies have a very strong business moat, they have a lot of experience as well, they have diversified customer bases, and going forward they believe that India, with respect to both the household income increasing, the domestic demand increasing as well as the export opportunity, augurs well for the stock.
Thanks very much for those details. Let's bring on board then Deven Choksi as well, who joins in on the show to discuss his outlook. Deven, why don't I start off by talking about the stocks that are powering ahead, and that's within the power sector. Of course, select names, the likes of a GE, a TND, Rathan India, etc. And on a year-to-date basis, despite the kind of financials they have delivered, the returns have been quite commendable. What are your thoughts on this space?
So, good morning, Evan. Well, I guess I think most of the companies which you mentioned in the capital goods space, be it in the power sector, I guess I think they are largely being followed because of the larger amount of growth prospects which are emerging due to the infrastructure related spending which the country is experiencing. Be it in the power generation space, be it in the power distribution space, or even for that matter, I think the companies which are equipment suppliers to the main OE companies, that is where probably I think we are seeing the large amount of actions. Not completely surprising though, but at the same time, I think as you rightly observed, the companies have had relatively, I think, uncertain past as far as I think the financials are concerned. They haven't been able to deliver on the financial numbers till now. Hopefully, with the kind of new order book position in respective companies' cases that they have, they should be in a position to correct that situation, at least start giving the stable to better performance. I'm not completely sure as to if the market has started giving very significantly high amount of valuation discount to these companies. I'm not completely sure whether I think these companies would be justifying that discount and probably deliver that kind of a growth in a shorter period of time. So I think that is a reservation that one can keep. But otherwise, yes, the outlook remains relatively better compared to what we have seen in the earlier past.
Deven, what went wrong with Reliance yesterday to see the crack that it did?
In my viewpoint, I think yesterday probably I think the offloading of stock has taken place from some of the, if I'm not completely off as far as numbers are concerned, but probably I think some of the larger ETFs have probably offloaded part of the portfolio, and that's where the stock price has come down. I don't think that the fundamentals of the companies have changed beyond a point, and neither I think it is going to have significantly large impact due to the tax I think which is being put on the crude because of the rising prices. I don't think that is going to be having a major impact. But offloading of the portfolio has created the situation, and not completely surprising though, because on the other side, US bond yields have started forming up. And as a result of which flight of capital is expected to take place in the at least shorter term, particularly for the leverage funds. Because of that reason, they would be selling what is sellable. Reliance kind of company, HDFC Bank kind of companies, I think they are having larger amount of equity in the marketplace with a higher amount of weight. I think they are sellable. As a result of which, I think this offloading has taken place. As I maintain, I think the correction in the stock price would always be a buy opportunity for companies like Reliance, companies like HDFC Bank for that matter.
You know, the bond yields, let's look at it. They're not at 4.4, but the dot plots are indicating that they will even head higher. Now just imagine if if the real interest rates in US, they close near to 4.5 or 5%, then you got to ask yourself is emerging market really worth taking a risk when you're getting 5% in the government 10-year, US 10-year paper? The answer to that may well be no. And that feature I think would be at play for next couple of months in terms of unwinding, something what Devan has just alluded to. But I'm going to change gears and back to our market. The macro adjustments will keep on happening. I've learned in my life is that if you're looking at long-term investing, macro trends will always create a volatility and opportunity for you to invest. But out of the blue, Nooresh, yesterday, we saw a big breakout in AU Small Finance Bank and it has moved against the grain again.
So a very interesting chart here yesterday. The stock gave a breakout on the short term. The last it had seen a gap down also a month and a half back. We are getting back into the gap. Now the next thing to watch is whether it can cross above the 800 mark. So for now, expecting a move towards 800. 800 is the previous 52-week high and an all-time high made in June, July. And the stock looks pretty promising out here. Would be a trade expecting first a target price of 800. If it crosses that, then it changes the momentum in a big way, because if you look at the last almost 2 years, it has made multiple attempts to create a new trend. It has topped out around 700 odd levels back in 2021-22. And now 700 acted as a base in this correction. So that's a strong indication, and above 800 could be a much bigger move. For now, expecting a move towards 800.
Devan, there's an interesting note from Morgan Stanley, which we were discussing earlier on Nykaa. They've maintained an overweight, but they've cut the target price to 173 from the earlier 175. Not a meaningful cut regardless. So while they maintain that the structural increase in beauty spend is quite visible in India, they're still not gung-ho about the fashion business, and they continue to see that it's going to be a little sluggish, and that's why that's going to trigger an earning cut for FY 25 to 26. With such strong competition, even in the beauty segment from the likes of Tira now, just wanted to understand where do you stand when it comes to Nykaa?
Well, I think point is very clear that I think the moat in the business is not something which is very convincing. And as a result of which, I think we believe that I think the business probably would not have significant amount of entry barriers either. It's a business which is driven by likes, and it is a business which is driven by, I think, the price points. So from that perspective, I think it is going to be always challenging as far as the margins are concerned. And that is another reason for which I think we don't immediately fall into this business, I think. And we like, I think, this kind of business to mature first on a sustainable basis. Currently, that particular factor is missing in Nykaa. I think we would like to see, I think, how the maturity prevails after the stores have been put across, and how exactly, I think, the growth is being experienced in subsequent quarters. Should that happen, then probably, I think, there is a case for investment. At this point of time, we feel that I think there are better opportunities available. As far as I think tapping the consumer's wallet is concerned, I think there would be definitely better opportunities available to invest into the market, where the growth is more predictable compared to, I think, this fashion business at this point of time.
135 points lower for SGX Nifty. So 20,000 on the Nifty today would be broken. HDFC Bank is down. Nooresh, another stock which has always intrigued me, and I've always had, not just one but two red flags when I speak about this one with all sincerity, is Tata Teleservices. Recent price action has been quite constructive, but yesterday it reversed. Just for the benefit of our viewers, because a lot of retail and HNI traders, they love to feed on this one. TTML.
So I think it's a stock which is best avoided. We saw a speculative move back in 2021, where it went from, say, first it had an initial move from almost 10, 12 levels to 30, 40, and then it went from this 30, 40 all the way to 300, and we are back to almost 60 in March, 50, 60 again. Now we've again seen some speculative move to 100. The business, there is not much clarity on what sort of a businesses are there in this company and what could come in the future, but there has been a lot of speculation in the last 2 years. And that speculation has happened in a couple of other smaller names also on the Tata Group, whether it is automotive, stamping, or arts and engineering. So the best place to avoid these names unless one has some more vision about the company.
Tata Tele, it's a Tata company. It has the word Tata attached to it. That gives comfort to everybody.
Well, I don't know. I think the market probably is not wanting to look into the financial numbers, and I think neither they want to see where the business model is appearing. And as a result of which, I think the euphoric condition is basically driving all the companies, I think, in the portfolio. When you actually talk to the managements of the companies, you realize that I think they are basically having the challenge as far as I think putting the company's business model into place. In my viewpoint, I think I would definitely want to see the clarity first before buying into any kind of stories in the market which are floating around. Maybe I think you have significantly better opportunities available, even at times I think slightly better expensive price. Still, at least you have the clarity available. So one would dive I think, with those companies where the clarity is far more visible vis-a-vis the, I think, the uncertainties existing in some of the names out here.
Okay, let's get some more fundamental ideas before we discuss other names with Devane. And here's Rakshit Ranjan as well as Sanjeev Haseen telling us what you can buy in this market right now.
TCS is in our portfolio of large cap consistent compounders. And then we have LTTS, Tata Elxsi in some of our other portfolios. And again, disclaimer, clients, families, and ourselves, we have exposure to these stocks. So these are some of the names on which we have increased our positions over the last 12 months incrementally. Because the concern of the market was US going through recession and hence let's exit IT, etc. That gave us some opportunity, some pockets to increase exposures in some of these areas, which we've done, wherever we see the resilience being there to the businesses.
The best play, which is going to be Star as far as the AI circle goes, and which is seeing huge amount of order inflows and high margins. Their attrition has been the lowest. And I think LTIM is one large cap which I can now bet on because it's on the index. So like I said, I'm focusing on large caps in the index. LTIM, Reliance, ICICI Bank, Axis. And if we are going to see Bank Nifty expire above 45,000, then both these large caps have to join. But LTIM is my stock for this from here till Diwali. 6,000 plus is coming on LTIM by this Diwali.
I'll spend a minute on HDFC Bank. Why? Look at what happened yesterday. Just look at HDFC Bank, and if you can look at the candlestick chart, maybe we'll get into a detailed analysis of HDFC Bank. But strong delivery-based selling. The ADR collapsed. When I say collapsed, 7-8% down. The ADR premium came down. So if you add all those factors together, Kunal, this is like a chart which tells you the stock has just changed the curve from being sideways to a clear down. It has moved from sideways to clear downtrend, right?
Yeah, Nikunj, sideways to clear downtrend, even though this is an intraday chart for HDFC Bank, but this also tells you that right from that gap down opening, it was not as if that the gap was bought into or the gap down was actually bought into. It was actually sold into, and you're absolutely right. I think the delivery data is also indicative of, I think, 61% in terms of the delivery numbers for HDFC Bank, and the volumes were pretty much high. So there was a strong base of delivery-based selling for HDFC Bank. 3%, 4% drop in the open interest for the current series. I'm not sure of the next series data for HDFC Bank, but that also indicates that there has been a major unwinding which has happened for HDFC Bank. And I think the more important part is the technical structure, that after such a kind of a gap which gets created into the stock price, it's actually like a major resistance which gets sets into the stock. So that 1600, 1625 odd mark, which is actually a decent short-term support, I think, and the gap which was created at the 1600 odd levels, I think that should now act as a major resistance for HDFC Bank.
All right. Meantime, we'll also have the spotlight on a heavyweight like Reliance Industries, which really buckled under pressure in yesterday's trading session. Curious to get your take, Nooresh, on the charts.
For Reliance Industries, what we saw yesterday was a big block deal happened right at the morning tick. Almost it was somewhere closer to 17 million shares, which happened around 2350, 2375. Post that, the stock just remained in that band and slowly tested that 2375 mark by end of day. So we need to see whether we hold on to that mark of yesterday of 2350, 2375. If that holds, then it could just be a one-off, say, downtick yesterday. Technically, 2300, 2350 has been a major pivot point for the stock. That is where it roughly topped out in 2020-21, and that has acted as a pivot point. So for now, we are close to that levels, which is where you want to actually be closer to this band. You want to be looking at a buy with a small stop loss.
What about your view on the entire cement space? The latest note by Bernstein suggests that while we have seen an outperformance in the last 1 year for the cement sector, now there's increased pressure from coal prices and new capacity, and therefore they've downgraded the likes of Ultratech, Ambuja, Shree Cement. Your view?
So on one side, I think the demand scenario remains completely convincing. And I think on the contrary, we are likely to see majority of the cement companies having a higher amount of capacity utilization. That should result into the better management of the cost, at the same time, I think margin protection, as far as I think the volume-based output is concerned. On the other side, I think the cost pressure has started rising because up till now slightly muted, largely because of the fact that I think your coal prices are once again rising. But likes of Ambuja and I think some of the other south-based companies, where they use the alternate fuel into the mix for the purpose of I think producing the power, I guess I think they would slightly be better off comparatively. In my viewpoint, I think the commodity is best when the stock prices are down for investment purpose. So I think maybe if the correction in the stock prices takes place, there would be headroom created for 20-25% kind of a growth into them, largely because of the fact that I think demand scenario remains robust. Slight amount of margin pressure is justified. And if the price correction takes place, the valuation is acting in your favor. So the margin of safety is higher for generating 20-25% kind of a return from these stocks. So buy when the stock dips. That is what the strategy should be.
Okay. Now look at the US GDP upgrade. How could we forget it? US Fed has come out and upgraded the GDP forecast. They went by back to IT. I mean, US GDP forecast has been upgraded by Fed. The soft landing is over. No fear of a recession. And if US economy is going to expand the way Fed is indicating, then IT companies should be really on the front seat now.
So I'm glad, Nikunj, that I think this view is getting validated now, because I think last few months I think we have been saying that if out of Fortune 500, only 30% of the companies are in the cloud computing today, the balance 70% and rest of the world, I think, will definitely demand for higher amount of computing space. Given that kind of a situation, I think there is no way in which Indian companies would not have the business going forward. Maybe I think there was a lull in couple of quarters in this calendar year, wherein I think they did not get enough amount of orders. But the managements of the companies kept on indicating that yes, I think the orders are getting ready, they are not getting released. I think that situation has started coming in. Many of the mid-tier IT companies have already started confirming that in this particular quarter, they've had a reasonably good amount of order inflows coming in. And I would like to believe that likes of TCS, likes of Infosys, which have created even relatively sharper focus on the cloud computing space, on the AI space, I guess I think they would be probably the prime winners of some of the large long-term contracts. And that is where I think I remain confident at the same time. Again, I think the view holds that I think here the 15% kind of a growth, if it comes in, then the stock price would have a reasonably good ground to appreciate by 15 to 20%. And in a market which is uncertain or where the sell-off is taking place, at such point of time, had you bought it, I think then probably I think you're making more money. We look forward to such kind of selling pressures in the market to buy into some of the select IT companies where the upside could be 20-25% in a year if you ended up buying at a lows.
Why? Where the upside is still left, 15%, 20%, that's debatable, but a double-digit upside in 6-8 months is coming.
Yes, I think I would think so. I think the upside, I think, is left in this particular counters, and we will probably see the larger amount of tailwind because of the order pipeline increasing.
One would you buy specifically?
So the choice remains with, I think, companies like LTTS, I think, which we love to accumulate into the portfolio in every dip. Choice remains with some technologies, I think, which is available at a valuation which is not as expensive, putting it around 20 kind of 40. So I think that remains, I think, a favorite of the lot because of the niche that they have created within their own space, different engineering space or different verticals in which I think companies are operating, particularly scientists operating in different verticals, including aerospace, where we see high and healthcare, where we see higher amount of, I think, order book inflows coming in. So these are the companies, even Tata Elxsi for that matter, I think gives a strong proposition. Of course, that stock is slightly premium traded, but whenever the comfort comes in due to the fall in the price, one could add into the portfolio. So we are comfortable with some of the mid-tier companies. And among the larger ones, Infosys remains, I think, relatively a better bet for us to add into the portfolio.
Why Infosys? Why not TCS or Tech Mahindra? Because TCS has got the growth advantage. Tech Mahindra has the advantage in terms of comfort, valuation, and change of management. Why Infosys? Because Infosys last quarter guidance was almost like a horror show.
Well, I think that is why we buy, because I think there really have to be some amount of contra buying taking place into this market if we really want to make money. Having given that particular guidance and having seen, I think, some of the larger contract deals that this company is signing in for relatively longer period of time, I would like to believe that I think if this inflow starts coming in, then probably I think the guidance would get revised. In these kind of companies which are priced to perfection in the market, where the larger amount of ETFs, etc., also operate in the market, you really need to buy these companies when I think they are available due to I think whatever the weak reasons which we are talking about. Because fundamentally the pictures do not change. In the shorter period, I think we might see a situation wherein due to this guidance of the cloud of the this kind of guidance, you may see a softer stock price, and that is where the time to buy into the company because rest of the fundamentals remains in place. So maybe I think for earning 20% kind of return out of this stock, you really have to buy when the stock is available at lower.
Go back to PSU banks yesterday. Well, some of them got smoked. Let's look at the pattern here. This is a promoter holding in some of the PSU banks. When I say promoter holding, it is GOI, Government of India. SBI has 57%, but in IOB, PNB, Union Bank, Canara Bank, not very high holdings, but IOB actually had a big bailout by the government, so the promoter holding is high. But the minute you flip it out and you look at smaller banks, UCO Bank, or for that matter, Punjab and Sindh Bank, the real small PSU banks, the holdings there are in the range of 95 to as high as 98%. Now stay there, stay there. UCO Bank 95%, Indian Bank 80%, Central Bank 93%, Punjab and Sindh Bank 98%, and Bank of Maharashtra 86%, which means 86% of Bank of Maharashtra's total equity capital is locked up. For UCO Bank, 95% is locked up. Only 5% is available for float. And if you look at data, and this is Monday's data, we've not tabulated Wednesday's data, some of these stocks now are trading equivalent to its free float, which means that whatever equity capital is available, because 95%, let's say in case of some of these banks, so 90% is already locked up, the stock is now trading equivalent to the free float. My limited point is that this is a sheer sign of momentum. I'm not saying that the banks are bad or the credit cycle is bad. No, I'm not saying that at all. I'm simply pointing out the price action and margin of safety. When you see price action which is close to its free float and when the government holding is tight, there is a lot of volatility is what you should expect. Devin Bhai, Nooresh, please feel to disagree with me.
So my view has been,
Yeah, anyone. You both want to disagree with me, right? Or both want to agree with me?
I probably do not want to disagree, but I think I would like to say that this is again, I think the market has created a situation wherein in the election year, when the government is not likely to divest public sector companies' shares, and as a result of which I think the free float in the market is going to remain comparatively tight. As a result of which I think because of the new funds which are coming into the market, definitely I think people would like to buy something which is missed out up till now. And as a result of which I think they would create a situation of, I think, buying into them. When you look at the fundamentals of these companies, they have never been bad. They are probably corrected now as far as I think the balance sheets are concerned. And the growth opportunity in the public sector bank remains always high potential. Whether they would be in a position to, I think, what you call, I think, grab that growth which is available in the economy, or whether I think some of the larger peers who are having a balance sheet also to, I think, find new customers or the borrowers for the on the corporate side. I think my take is that PSBs would always remain with small SMEs and MSMEs, I think largely. Whereas I think that some of the larger banks with a balance sheet will probably go with some quality borrowers. So to a greater extent, I think you will not be able to justify the higher amount of valuation for these PSBs, even though I think there is a case for the low liquidity, and as a result of which I think we are asking for higher price. In my viewpoint, I think it's momentum driven at this point of time, and where I agree with you that I think this particular momentum is likely to continue for some time, because government is unlikely to release stock or sell the stocks of public sector undertakings in the election year ahead.
Even the market is also quite excited about the electronic manufacturers, right? Just this morning, there's a note from Morgan Stanley upgrading and initiating coverage on Keynes, on Shirma, SGS, etc. Just wanted to understand, where are your thoughts on this sector and whether you would recommend buying any of these names?
So certainly, I think few companies which are there in the list, I think among them one is the DCX system, where probably I think they are largely supplying to the businesses like I think railways and the defense, which is I think more industrial business than a consumer business supply, as we call it in the EMS space. I think they are typically I think out there. However, the point remains that I think because of such large customers, they always have to be extra careful about pricing the product. And that is where probably I think the margins are always going to be under check. That is the first point. Second point, even though there is a supply which is happening, it's not going to happen that in 1 year they'll be supplying 50% growth and next year 100% growth. The growth is also going to be, I think, 15 to 20%, because the OE on the other side is also going to follow the program which is undertaken for the supply to the end customer. So in my viewpoint, I think one should not be getting euphoric in this particular space. We'll have to keep level head on this particular aspect. There is going to be growth, there is going to be opportunity, but at the same time, I think keep an eye on whether they will generate enough amount of margin. Keep an eye on, I think, whether they will generate enough amount of growth beyond 20%. If that does happen, then certainly there is a case for premium valuation. Otherwise, I think these premium valuations are going to hurt at some point of time to people who are not looking at the financials of the company.
Do you think that applies for defense also? That applies for railways also? These are companies which will not grow at 50%, but P multiples are now 70, 80 times.
Absolutely. Absolutely. I think have my own case out here and doubt here that these companies will not be able to, I think, report the growth with 50%, 70%. You're giving them a significantly high amount of valuation, largely because of the fact that there is a visibility of business for next 3 to 5 years. Agreed. But they'll be able to report the growth of 15 to 20% at best, in some cases slightly higher. But beyond that, if it is not happening, and being the government as a main customer for them, margins are not going to be available to you. I think you will have to work on a very tight margin. And in a given situation, if you have not been able to manage it, probably I think you are going to disappoint the investors. So I would always remain watchful about this aspect, that while the fundamentals of this company are shaping up good, I would rather remain careful about paying the higher valuation. Current higher valuation is being paid because I think there is a less amount of floating stock in the market, and there are higher amount of investment tickets, I think, which are basically checks are being cut for the higher amount of investment. As a result of it, these stocks are going up in a crazy manner. I would rather like them to be a little bit more decent as far as the valuation is concerned before putting, I think, money. Though I must say that in some select companies we have taken early bet and we stay invested. However, I think putting a fresh money into this particular area of activity, one will definitely look around for the opportunity at a price and not otherwise.
Right. Okay, Devin, great to have you on the show as always. Thanks for taking the time out. Let's move on. Let's just revisit what the pre-open rates are settling in at. What is Reliance up to? What's HDFC Bank doing, considering these were the big drags on the indexes yesterday? Let's just have the Nifty rate for you on your screens, and it's indicating towards a bit of a quiet start for us, but let's see, these are just early rates and where we head from here, because remember the implied Nifty adjusted for yesterday's close was already indicating a sub 19,900 start, and that's where we pretty much shut shop yesterday too. But Kunal, any mid-cap stocks on your radar?
So yeah, Granules is something which looks interesting. The stock closed at 330 plus mark. Bullish candle for the stock on the daily basis. So would suggest a buy with 350 as a target and stop loss to be kept at 320.
Right. Nooresh, what about your mid-cap ideas?
So for a change, we have the same idea. Today, it is Granules India again, one of the few stocks which showed relative momentum yesterday. Gave a breakout 2 days back, also did a dip and again back above the 330 mark. So could see a move towards 370 levels, stop loss at 320.
All right, let's move right on and also get you some cover on D Street. MCX is going to be in the spotlight, and according to reports, the company will go live on the new trading platform by the end of this month. What else is going to keep the stock in the spotlight? Let's find out. Sharad has the details.
Well, yes, in focus we are having MCX, and a recent circular had come, and that is actually stated that the proposed new software trading will actually start happening by the platform by the end of this month. Now, also important development is that from September 1st, the mock trading sessions had started. Now, we had a channel checks, and over here we are seeing that the last testing session, some bugs were there, but now the entire issue has been resolved. And also one more mock trading session is expected to happen. It's expected to happen today on 21st September. And if the software is not launched by the month of October, it's expected to be launched in the month of December. And our channel checks suggest that this is because of an expiry coming for both gold as well as silver. That's why there might be a delay in the launch, and there has been an overhang in the stock because each quarter there is a delay happening for the software implementation. 125 crore rupees loss is being actually garnered to the company. Now, emailed inquiries were sent by ET now, but no reply has come from the management of MCX.
Okay, Sharad, we'll leave it at that. That's all the buzz on D Street. But let's tell you what else is happening outside the world of equity markets. And the Women's Reservation Bill passed in Lok Sabha yesterday is set for another litmus test today in the Rajya Sabha on day 4 of the special session of Parliament. Opposition has backed the bill, but with a twist, has sought delinking of delimitation and quota within quota for OBCs. Also, PM Modi has invited US President Joe Biden to be the chief guest at the Republic Day celebrations next year. The invitation had been extended at the G20 summit held in Delhi. US envoys. Remember, the last US president to attend India's Republic Day celebrations was Barack Obama back in 2015. Also, British Prime Minister Rishi Sunak has laid out a shift in strategy towards achieving the country's net zero climate action targets. This includes a delay of 5 years in imposing a proposed ban on petrol and diesel cars. The ban is now shifted to 2035. He called it more pragmatic and realistic a path.
Meantime, the biggest push yet to promote cricket in the US. The ICC has said that the US will hold the men's T20 World Cup for the first time ever. It's confirmed that Dallas, New York and Florida will be holding this and hosting this popular event. Meantime, Amazon is supercharging its devices and services with generative AI in their September hardware launch event. They announced the new Echo, the Fire TV devices, and revealed how Alexa is getting generative AI and a number of other interesting innovations. With generative AI, Alexa is going to become more powerful and conversational as a virtual assistant.
And power stocks, they've been all the buzz of late, haven't they? Let's take it across to Nikunj and find out his take on the same.
Let's understand the dynamics which are at play. Not every power company is bad and not every power company is great. Power is not like, banks where you can look at NPA cycles and the credit cycle and then you would say, okay, one will grow, other will grow. It's about the difference between the growth, who gets more. In power, it's a very complex sector. There is merchant power, there is there are PPAs, there is installed capacity, there is fluctuation which happens, there are overdues. So all I'm saying is that in power, just don't buy because there is a prefix power or there is a suffix power. You have to do your homework when you're buying into power stocks. And all the companies which are there on your screen, they have different business models, very different setups and very different, very different template in terms of how the business would be done. Now, why am I bringing this part up is all I'm trying to bring out here is that look at some of these companies and I don't think some of the names on your screen have anything very, very strong in terms of the operating, template they have. So FY24 is not going to be dramatically different and nothing meaningful will change in FY25 for some of the power companies. And these stocks are moving up like a rising tide. So it's a rising tide phenomenon, which I think is at play, at least in the mid-tier and the tiny toons of the power sector. And when that starts happening, you could ask yourself, why? Is it worth it? Where is margin of risk? Just don't get drawn because there's a rally in some of the big power companies and you are reading a headline about power shortage. Yes, there are few power companies, we've discussed them. They are in a sweet spot given where the power demand and the dynamics are moving. But that rub-off effect, I think, is now visible in equity prices in some of these power stocks, and which is where you need to be careful of. That's my limited point. I'm not judging. I'm putting facts out on the table.
All right, let's get a move on then. That's the view coming in on power stocks and find out what the view is on the index. Yesterday, the heavyweights really came and buckled under pressure. And here's the strategy from our chartists on the Nifty. No trade, a buy on tips and a hold. So it's divergent views coming in from all three of our chartists this morning. Ditto is the case with the Nifty Bank. They're maintaining the same stance as the frontline index Nifty. Remember, yesterday, pretty much all sectors buckled under pressure, including the Nifty Bank index.
Let's look at the most talked about space right now. First is power. We've just spoken about it. The second is PSU banks. Kunal, will be very repetitive, but it's important we revisit it. How would you approach small PSU banks?
I think the major part of the rally for the small PSU banks seems to be out. I think it's a good time to now either book profits over here or look out for adding on to positions on the large cap names in the PSU banking names. So, even in the last 2 days, for example, Bank of Baroda, SBI, they've hardly shown any major signs of peaking out, and they've gone through a very tepid kind of a correction. Even Canara Bank is looking quite strong at the 360 plus mark. So I think it makes a lot of sense to shift or make that shift. Whether it's a temporary shift or a permanent shift, I think we'll come to know on how deep the market correction shapes into. But even if it's a short-term portfolio adjustment, I think it makes a lot of sense to shift to the likes of SBI, because if the PSU banking stocks have to get a next leg on the upside, it has to led by large cap PSU banks to make a comeback, and specifically the likes of SBI, which could make a comeback possibly about its 610 mark.
Nooresh, same question for you as well.
So a clear avoid on the small cap banking names. When you see a IOB have a market cap greater than Canada Bank, just does not make sense. So we've seen it correct almost 30-40% the last time it peaked out. And again, could be a similar case for a lot of these names where the correction could be 20-30% from the top. So IOB went from somewhere closer to 36 odd levels to a dip to 26 in less than 1 week back then saw recovery and then back to 22. So that's a huge correction. Same way from this 45-48 levels, if it goes back to 30-35, won't be surprised.
In the pre-open session, now that rates are adjusted, it is clear that we will start below 20,000. So 20,000, well, psychologically it's gone. But that was never important, right? Psychology, feel-good factor, let's take it away. Let's talk about the resistance and the support now. What is the support for Nifty?
So 20,000 becomes an important support, Nikunj, because round strikes at 19,000, 19,500, 20,000, these are strikes where there is a lot of option writing. And when the index was trading above that 20,000 mark, 20,200 I think is where we closed on I think 1 day previous week. That was a point where there was a huge amount of writing of put options at the 20,000 strike. And yesterday, most of the strikes got unwound and the index closed quite comfortably below the 20,000 mark. So on the way up, if 20,000 acts as a support, then on the way down also 20,000 would act as a major resistance. So I think it's not just a strong psychological mark or a round figure number, but it also holds a lot of significance in terms of option data.
Okay, SGVN. Why is important? Because government is planning in OFS. The government holding in some of the PSU names, and I'm not talking about banks here, has been historically very high. HAL, SGVN, RVNL, RNL. The government holding is very high. And the government, I think, has done an excellent strategy of not selling or reducing their stake via the ETF route, something which had become a bugbear a couple of years ago, where the government ETFs were continuously coming out. You call them as Bharat ETF, which was a combination of some PSU stocks. But now that stock prices are at a record high, just think from their standpoint. I mean, this is a market where they have to meet their disinvestment target. It's a market where valuations have been really out of swing. So it may be a time when if they're able to raise some capital by reducing some ownership in some of the over-owned, over-expensive stocks, it's not a bad idea really from a government standpoint. But what it means that in the near term, the risk of supply in some of these stocks may actually increase. I think that is something what you may see going forward. We've not seen too many OFSs this year, but that could be the risk going forward. First rates on your screen, and it's going to be a downtick for the Nifty, a downtick for the Sensex, and a downtick for the Bank Nifty. HDFC Bank, in a sense, has acted like a sledgehammer which has broken the back of the bulls, at least in the near term. Bank Nifty is down another 200 points. HDFC Bank is down another 22 points. So it's almost like a 1% kind of a cut, 1.5% kind of a cut for the Bank Nifty, and also for 0.5% cut for the Bank Nifty and 1% plus for HDFC Bank. Now let's roll it over to some PSU banks, especially small denominated PSU banks, both in terms of size and in terms of market cap. IOB, UCO Bank, Central Bank. It's a rub of red for some of these banks right now. Good. SGVN. 8% down in the pre-open session. I'll not be surprised if it is anywhere different now. Let's look at some other government stocks here. PSU stocks, if I may use that broader terminology, railways and defense, all of them actually HAL, SGVN, Power Grid, Power REC, that entire Kahoot, so to speak, in terms of where those prices are. Not too much of a collateral damage, so it's very specific to SGVN where there is news of OFS. Aisha?
Let's check in on what Reliance, HDFC Bank is are up to, considering they were the ones being heavy on the indexes yesterday. Those stocks will just come up for you on your screens. Besides that, there's Infosys as well, wherein Infy and Nvidia have collaborated to help world's enterprises to boost productivity with generative AI. So just want to check in on Infy, not seeing much of an excitement there. There's Morgan Stanley, which has initiated an outperform with a target price of 24.40 on Keynes. On Sirma SGS, outperform initiation with target price of 671. So look out for what both these names do in trade. SGVN, of course, is tanking as we speak. It's an 8.5% cut that you're seeing on the stock, like Nikunj flagged off. The Sheela Foam as well, wherein they've approved a floor price of 11.33 thereabouts per share for a QIP, which is at the discount to the current market price. The stock, of course, has moved up 2.25% as we speak right now. DCB Bank, they've got an approval granted by the RBI to HDFC AMC to acquire the aggregate holding of up to 9.5% stake, 2% higher for DCB as we speak right now in trade. There's MCX as well, which is proposed to go live on new trading platform by the end of this month. So MCX has gapped up 3.5% as we speak right now. And then, of course, there's Biocon as well, wherein the European Commission has given its nod for one of their biosimilars. So look out for what that stock as well does in trade. So that's pretty much the trading texture and flavor this morning. I also want to check in on AU Bank, Polycab, and then, of course, on RR Cable as well. Remember, that was the big dhamaka listing from yesterday. Closed in at a premium to its issue price. Let's see what it's doing on day 2. 1% higher, 1208 is where RR Cable is currently in trade.